Tax-efficient fund placement. In the world of investing, this is one of the few ways that you can actually increase the return from your portfolio without impacting the risk, and you can do this by minimizing the total tax burden of your portfolio over time. In this video, we'll walk through an overview of tax-efficient fund placement, what it is, the general strategy, and how you can actually put it into practice to start saving you money today. If you're new here, my name is Michael, and take a second to subscribe for more investment content like this in the future. Now let's start off with an overview. What exactly is tax-efficient fund placement? It's actually an issue that many investors face who have assets in multiple accounts, specifically in tax-advantaged accounts and regular taxable accounts. In this video, we'll be specifically focusing on investment accounts for US investors, but the same general concepts also apply to international investors. What makes tax-efficient fund placement beneficial for US investors is that different assets are taxed differently based on which account they might be situated in. In addition to that, the returns on some specific asset classes are taxed differently, meaning they'd be more beneficial to be held within a certain type of account. For example, if you invest in a total stock market index fund like the S&P 500, that's relatively a very tax-efficient investment. This is because most of the dividends produced by that fund are qualified dividends eligible for a lower long-term capital gains tax rate. On the other hand, certain investments, for instance, investing in corporate or high-yield bonds, are very tax-inefficient investments because the interest from those bonds are counted as ordinary income and taxed at your highest marginal federal tax rate. Now, while you won't be able to avoid paying taxes altogether, you can minimize your overall tax burden regarding your portfolio by being smart with how you place your assets within different accounts in your portfolio in a strategic way to reduce those tax liabilities. Now, when it comes to investing in the United States, the majority of your assets will likely be split across 3 different types of accounts. This would include traditional retirement accounts, Roth retirement accounts, and regular taxable accounts. Traditional retirement accounts are the most common retirement accounts, and they are tax advantaged, meaning that money that you put into a traditional retirement account, whether that be a deductible traditional IRA or a traditional 401k, will provide you a tax break up front when you contribute to the account. Put another way, the amount that you contribute to a traditional retirement account doesn't get taxed on the way in. Once it's in the account, it also grows what's called tax deferred, meaning that any dividends, interest, or capital gains that you incurred in the account won't get taxed until you eventually withdraw them near retirement. However, once you do finally make those withdrawals, you will have to pay ordinary income tax on those distributions. Roth accounts, on the other hand, are sort of the reverse of traditional retirement accounts, and they're quite popular for younger individuals and those who are generally in a lower tax bracket. This is because the way Roth accounts work is that you pay taxes up front when making contributions to those accounts, but once that money is inside the Roth account, it will grow tax-free, meaning that all future capital gains, dividends, and interest that you earn in that account will not incur any taxes while it's in the account. And in addition, when you finally do withdraw that amount from the account, you can withdraw it tax-free. Because Roth accounts offer the option of tax-free growth, they're particularly useful for tax-efficient fund placement, especially if you're able to contribute to them at a low current tax rate. The other main account type is just a traditional taxable brokerage account. And this account doesn't provide any direct tax advantages, but it does provide you full access to your money anytime, something that traditional and Roth accounts restrict. Now, while everyone's tax situation is different, generally speaking, if you have the ability to contribute to tax advantage accounts, most of the time it's beneficial to do so before filling up your taxable account. This is because both traditional and Roth accounts provide tax-deferred growth while the money's in the account and provide a tax break either upfront with the traditional or tax-free growth with the Roth. However, there are a few unique advantages of holding assets within a taxable account. For example, if you hold very tax-efficient investments in a taxable account, for instance, an index fund or long-term holdings within individual stocks, because most of those dividends are qualified dividends at a lower long-term capital gains tax rate, you're unlikely to incur significant taxes from those holdings, especially if you buy and hold them for the long term. And if you do sell and it's been more than a year that you've held the stock, you'll qualify for the more favored lower long-term capital gains tax rates. Another advantage of having assets within a taxable account is that if, for instance, let's say you have a relatively risky investment and you incur a loss and decide to sell out of that investment, then if you have that asset in a taxable account, you're actually able to write off that loss on your taxes, which can help reduce your taxable income. If you sell an asset for a loss in a traditional or Roth account, you're unable to write off that loss on your taxes. And a final benefit of holding assets within a taxable account has to deal with estate planning. If you're holding assets in a taxable account that have appreciated significantly, if you hold those assets through your death and then pass them on to your heirs, they will inherit those assets at what's called a stepped up cost basis, meaning that instead of having to pay all that large capital gains tax from the appreciation over your lifetime, they're set at a new cost basis, so when they inherit the stocks, they don't have to pay any tax liability. This can potentially be a huge tax benefit and is one of the ways that many families can pass on wealth to future generations. Okay, now that we have a better understanding of the account types, there's two more things we need to discuss before we can start putting this into practice. The first are tax rates, and the second is the tax efficiency of certain assets. Let's start with the tax rates first. In the US, federal income tax is a progressive tax, and it's based on a set of tax brackets. Based on your calculated taxable income at the end of each tax year, you'll fall likely into one of these brackets. Now, these rates will likely change over time, but this is what they are in 2020. If you're in the 22% tax bracket, it doesn't mean that all of your taxable income is taxed at 22%. As you work your way through the brackets, roughly the first $10,000 for a single individual is taxed at 10%. Then once you move into the next bracket, in this case the 12% bracket, your income is taxed at 12% until you hit the next threshold. After moving into the next tax bracket, every new dollar after that is taxed at that higher bracket. The most important concept from this is that whichever tax bracket you're in, any additional dollar you make will be taxed at that rate. Now, ordinary income tax rates apply to almost all income that you make. However, for some specific type of investments, you can qualify for what are called long-term capital gains. When you have long-term capital gains, investments held for at least 1 year before they're sold, or qualified dividends, these qualify for a lower tax rate than ordinary income taxes. In many cases, this is a significant tax benefit. For instance, if you're a single individual in 2020 with less than $40,000 of taxable income, any qualified dividends you receive for that year are at a 0% federal tax rate. The lower long-term capital gains tax rate is one of the biggest tax advantages you have at your disposal when deciding how to allocate your assets. Now, we've alluded to this a bit already, but one of the key considerations in where you place these assets is the tax efficiency of these assets. How much taxes are they likely going to incur based on which account they're in? Tax efficient investments generally don't produce significant tax liability when held in a regular taxable account. On the other hand, tax inefficient investments can produce significant tax liabilities if held in a taxable account that could significantly erode away at the potential investment returns you could be earning. For that reason, it's generally recommended that tax inefficient investments are held within a tax advantage account like a traditional or Roth IRA or 401k, so that the interest and dividends from those investments are tax deferred and you don't have to pay that liability right now. So what investments are the most tax efficient? Well, likely up at the top of that list would be investments in US-based companies that are held for the long term. The reason being is that for US investors investing in US companies, most of those dividends will be qualified dividends, which allow them to pay the lower long-term capital gains tax rate. This can be investments in US stock index funds like the S&P 500 or individual stocks like Apple or Procter & Gamble. When it comes to moderately inefficient investments, we're looking now more at our lower yielding bond investments. This can include moderately yielding money market funds, bond funds, and even some individual bonds. Also less efficient are any actively managed stock mutual funds or any stocks that you trade without holding for an entire year. This is because the capital gains from these investments typically incur taxes at your ordinary income tax rate. That's the higher rate that you want to try avoid paying on your investments as much as possible. Now, when it comes to your most tax inefficient investments, these would be your high yield or higher yielding bond funds or bonds, as well as some REIT or real estate investment trust investments. Now, recently there has been a change to the US tax code that has made investments in real estate investment trusts more favorable than at least before by being held in a taxable account. But generally speaking, I think there's probably still recommended to be held within a tax advantaged account. The reason that these investments are considered very tax inefficient is because they have relatively high yields paying interest or dividends that aren't generally considered qualified dividends that qualify for the lower tax rates. Two quick notes on other types of bonds. U.S. Treasury bonds, or bonds issued by the United States government, are exempt from state income taxes, but you still have to pay federal income taxes on them. Municipal bonds issued by a state or local government are exempt from both federal and state income tax from the state that they were issued in. This can be an actually relatively large tax advantage, especially for some investors who are in high tax brackets right now. However, the drawback of municipal bonds is that because of this tax advantage, they typically have a lower interest rate than a similar corporate bond or a bond issued from a business that has a similar risk being same credit duration and credit quality. So now that we have a good grasp on all the aspects of tax-efficient fund placement, we can start determining a plan for how we can allocate these assets between our investment accounts. The first thing to consider is your asset allocation. Generally speaking, what percentage of your total investable assets you want allocated to stocks versus bonds. There are other asset classes that you can invest in as well, but these are the two main ones we'll be dealing with for this example. In addition to this, take account of how much space you have in each of your accounts or how much ability you have to contribute to some of these tax advantage accounts where you can put some of these assets in. Because there are annual contribution limits to tax advantage accounts, these will likely be the most limited in size because you can only contribute so much to them per year. Then finally, you can start optimizing the placement of your assets in the most tax efficient manner. In this example, we'll say we have $100,000 that we want to have invested, roughly 70% stocks and 30% bonds, and we have access and space within a traditional and a Roth retirement accounts, as well as a taxable account as well. The first thing we want to do is make space for our least tax efficient investments or our most tax inefficient investments. For many people, this will be their bonds. The ideal account to hold your bonds is likely your traditional IRA and traditional 401k. This is because the interest on those bonds will be tax deferred in a traditional IRA or 401k, and you won't have to pay taxes on those investments and interest until you finally withdraw them at retirement. Now, you can also put these bonds in your Roth IRA, which has the same tax deferral benefit, but as we'll get to in a second, there is a reason why you might want to save space in your Roth IRA for other investments. The next step, generally after placing your least tax efficient investments, is to place your international stock investments. I didn't mention this earlier, but these investments likely want to go in a taxable account, and the reason for that is that any income tax that you pay to a foreign government for income or dividends received from those international stock investments, if held in a taxable account, you can get a credit for those taxes paid, so you don't have to pay US income taxes on those dividends again. You can still certainly hold international stock investments within a tax advantage account, but you lose the foreign income tax credit. Next, after that, you want to take a look at what you think likely are your highest return investments. These investments you might want to consider putting in your Roth IRA or Roth 401k. The reason being is that if these are investments that are likely to see significant rates of capital appreciation over the long term, they would see the most benefit from being in a Roth account because all of those capital gains would then be tax-free. Finally, once you have all those other steps done and assets placed, you can place your most tax-efficient investments. These again would typically be your index funds or individual stocks that you plan on holding for a long time. These funds are generally fine in any account, but if you're going to hold them and don't have plans to sell, it might make sense to hold them in a taxable account where they're still relatively tax efficient, but that makes up space in your tax advantage account in case you want to add more tax potentially inefficient investments later down the road. This gives you a bit more flexibility with potential rebalancing or future changes to asset allocation where you might wish you had more space in your tax advantage accounts to hold potentially, for instance, more bonds. So for this example, with that $100,000, you might put $30,000 into bonds within a traditional 401k, take $10,000 of your highest growth investments and put that in a Roth IRA, and then take the remaining $60,000 of your tax efficient investments like a stock index fund and invest that within your taxable brokerage account. Tax-efficient fund placement is a strategy that I use personally within my portfolio to help minimize the overall tax burden that I have to pay each year and hopefully throughout the life of my portfolio. Now, it's important to keep in mind that everyone's tax situation is different, and the tax system itself does change from time to time. This isn't intended to be actual tax advice, but hopefully it provides some perspective on some strategies that you can use and look into to potentially lower your future tax bill. Taking proactive steps to lower the taxes in your portfolio is one of the few ways that you can increase your after-tax returns without sacrificing by taking more risk. Overall, I hope you enjoyed the video. If you did, consider leaving a thumbs up. It's the best way for me to know that you got value from content like this. Until next time, my name's Michael. Thank you so much for watching, and I will see you in the next video.